right, traders, welcome out to your market roundup for January 17th. Corey here with you. Plenty to cover, so let's jump right into it. So today was a day where the markets really didn't do much. Now, as you look at the returns, you see the Dow at negative 1%, and it's kind of the outlier, right? The S&P, the NASDAQ, the Russell 2000 small caps, they were all flat. I mean, perfectly flat on the day. So why was the Dow down 1%? Well, the Dow was kind of an outdated index. It's only 30 stocks and it's price weighted. So the bigger the price you are, the more impactful you are on the index. And it just so happens that Goldman Sachs missed on earnings, traded sharply lower, and it weighed down the Dow. But that's Dow specific. As we look at the rest of this, oil was up 1.48. We had an end of year review, full year forecast video a week or so ago, and myself and Rob and Darren kind of disagreed on oil. I said it'll be higher. They said lower. I I have to caution a little bit in that I think it's going to be, I've talked about markets rally early and then we might have some turmoil late. So they might be right later on this year. But since that meeting, I mean, oil's up 8% or whatever. So in the short term, we are getting that pop. It's a question of what transpires later this year, and that's going to be harder to predict. I do worry though, that it is going to get a little uglier in the markets later this year. And that's when my oil thesis would kind of switch. But I think we can push higher in the shorter term and maybe still finish positive just because we could be up quite a bit early on. And so even though we might fall in the back half, maybe we'll sneak a profit for the year. Gold down 0.5%. On the advanced decline line, about half and half. Half going up and half going down today. The 50-day moving average, look, we're in a bullish market environment in the short term. 76% of stocks are above their 50 MA and trending higher. On the daily news, like we said, Goldman Sachs, big miss on earnings. Also, staff reduction. They're going to cut jobs. That's been announced. There was Microsoft that announced they're going to cut 5% of their workforce today. So there are some things coming in. It hasn't been a full-blown market turmoil or anything, but certainly some slowdown. And then Bank of America said they see a recession in late 2023. That's kind of where I would be. Now, the markets are pricing in Fed rate cuts later this year. The only way the Federal Reserve is going to be cutting rates later this year is if the economy takes a swing to the downside, right? Think about it. If the economy's strong and we're able to work through some of these things and inflation comes down, why are they going to cut rates? They're only going to cut rates essentially and back up if they need to. And why would they need to? Well, maybe a recession. So the markets are pricing in a recession, but not until later this year. And that's been part of my thesis for why I've been bullish on the market. So let's take a look at the market charts, and my thesis is playing out. We've touched on it a lot. I'm not going to rehash everything, but there's a lot of different factors in play that really had me turning bullish down here. And the reason that I thought, and kind of changed my tune right in here, some of it's technical. This was a 50% retracement. The market was able to shake off some quote-unquote bad news. When you get bad news and good price action, that's a little bit of a market tell. But it was also fundamentally driven a little bit. If you look at CPI, it's been trending lower the past few announcements. And in fact, it just came in last week at minus 0.1. And I knew that the way CPI is calculated year over year, that we're getting rid of some big high CPI numbers back here, and we're putting in some low or zero or even negative CPI numbers. And so what does that do to the annual inflation rate? Well, it takes time because you have some of these numbers. I mean, there was inflation, month over month inflation at 1.4% in the summer of last year. And so we're not getting rid of those yet. That's why annual inflation is at 6.5. But as you kind of push forward, the way that it's trending over the last 4, 5, 6 months has an annualized inflation rate of 2%, which is the Fed's target. I don't think we'll get there, but we will get rid of some of these big numbers here in the coming months. and it will come down. I think inflation is going to continue to trend down from 6.5, but it might get sticky in the fours, and that's where it gets kind of tricky for the markets. That's a story for another day, but that's certainly, a factor that's in play. Also, we just have this transition from quantitative easing to quantitative tightening. These things ebb and flow. In my trading history, I've really seen three major bear markets. In 2000, the tech bubble burst. In '07, the global financial crisis, real estate induced. And then I'm going to call it the 2020 induced, but 2021 bursting of the crypto NFT, just massive risk taking that was kind of ridiculous in a lot of ways. These are three major bubbles, and I do believe that this one is pretty significant. Each one of those were fueled by easy monetary stimulus, by easy policies that made capital readily available, and it created the bubbles that popped. And each one of these was driven by envy, because nobody likes to see others making money without them, do they? This is what casinos are built on, have people screaming and yelling and celebrating, and people will open up their wallets and go to the craps table along with everyone else, or go to the blackjack table. Well, in 2000, every tech stock was booming and people were making a fortune on paper, and so everyone said, well, if it's that easy, I need to get involved. And envy drove a bubble, and then the tech market lost 85% of its value. In the middle 2000s, real estate, everybody saw others making money without them. They said, well, I can do that too. Interest only loans, get my fourth, fifth, sixth, seventh, eighth mortgage, buy all these properties, and of course that collapsed because it was unsustainable. And then in 2020 with COVID, they started sending out paper. They printed trillions upon trillions of dollars, PPP loans. There was just so much capital readily available, and it fueled not just cryptos and NFTs, but that's kind of what I would say was the peak of kind of the stupidity of it all. I mean, Justin Bieber and these guys paying millions of dollars for some monkey on an NFT or something, and it's just a greater fool theory. It's basically, if I can sell it to someone else for more, then I'll make money. And there are a lot of fools out there that thought, some little picture of a monkey was worth millions of dollars, I guess. But ultimately, that has collapsed, right? And most of those have lost 90+%. And most of the coins out there, I mean, you think about Dogecoin and people piling into it, even though it was a joke coin. It was not ever meant to be serious. And it's just envy. It's people don't want to see others making money without them, and the bubble burst. And what's common about each one of these is it wasn't a simple fix. It wasn't just, hey, you go down a little bit and it's all fine. The tech bubble had to get annihilated. The global financial crisis created massive problems. The crypto NFT and everything bubble in a sort of way is going to probably spike to a VIX of 40 plus. Every one of those had a VIX that spiked up to 50 or higher. I would anticipate that this bear market's not done big picture, that we still have some things that are working. And so my thesis has been, right, we're short-term bullish, and that's working. We're up, 6% or whatever. I think there's more. I think you back and fill here a little bit. You break the trend line. You trend higher for a little time. Everyone says the bear market's done. It's dead. Get bullish, and that's okay in the short term. As a trader, there probably is a little more money to be made on the upside. But when you spike, if you get a big exhaustion day, if you, similar to this, see this huge candlestick? If you see the market go on a run and then it puts a big exclamation point, believe it that that's the end of the sentence. Believe it that that's kind of the finish line. And so if I see the market run higher in the next couple of weeks and really put an exclamation point on the end of it, that to me would be a time to take money off the table. And that's probably the peak of this cycle. Ultimately, as I said, part of it's technical, If you follow Elliott waves, this is kind of a big, huge 5-wave pattern through 2022, right? And this to me is the ABC. And where does the ABC usually go? Back up to about wave 4. So we've got about half of the upside so far, and that's a big rally, but that's only probably half-ish. There could be another half of that and a big exclamation point up here, and then all hell very well might break loose. Now the NASDAQ has lagged. I think what will put the finishing touches on this is probably some sort of bounce back in mega cap tech. So Apple, Amazon, Google, some of those names should bounce back and should rally sharply, but it's ultimately going to be kind of a sucker's rally in my mind. I don't think the bear market's dead. I don't think it's done. My opinion is we're going through a transition from easy money to harder money, from easing to tightening. And this is going to be a multi-year adjustment. The best analogy I can think of is somebody that's addicted to drugs. I mean, that's kind of what the market is. It's been addicted to drugs. Now we're in rehab, and you'll have some good days, you'll have some bad days. I've never been in rehab, I've never used drugs, but I know kind of the basic principles of it, right? And we're having some good days here, but I think it's going to be a couple of year process to kind of get the market adjusted. I don't think interest rates are coming down dramatically. I think we've got to adjust to a world with higher interest rates. That means lower corporate profits. That means a more difficult market in terms of its ability to trend higher. Now, that's good news for us as traders because we can trade the market in front of us. We can make money as stocks go down. Sort of bad news for the long-term investor because I think it's going to be a challenging couple of years. Okay, so let's take a look at the heat map, and a couple of things stand out. Tesla with a huge bounce back day. They had price cuts and the inventory sold pretty rapidly. So good news for Tesla. Amazon back down a couple of percent. Nvidia getting a bounce. It's just kind of a mixed picture. Pfizer down on a downgrade. Chevron up a little bit more, but there's little pockets. I mean, Morgan Stanley and Goldman Sachs are usually highly correlated. Not today. Morgan up big, Goldman down big. So it's just kind of that day. Again, it's a sideways day overall. There's some hit and misses, but the market as a whole, I would say, half went up and half went down. Now, as we look at the markets, it's been my personal thesis. I've been short-term bullish. Even when the market was a little ugly a few weeks ago, I really felt pretty strongly and pretty confident that max pain was a push above that downtrend line. The put to call ratio was skyrocketing. People were so bearish, and we're going to eliminate a lot of those puts. We're going to let them expire worthless by markets punching higher. So that's playing out. That thesis is intact. We're basically up there towards the trend line. Should kind of back and fill a little bit for a couple of days, but ultimately punch through and then rally up. I mean, I'm expecting another couple of weeks potentially of upside, and just watching for kind of that exhaustion day, watching for that probably spikes higher on some really good news. Again, the markets at that point will be saying all is well. Markets are back in an uptrend, nothing to worry about. And that's where I would get nervous, but that's a ways away. So for now, we're just kind of pushing higher in the short term. Let's look at some potential bull and bear candidates. So first on the bullish side, this is a stock that I highlighted last week, and I said at the time we were below these moving averages, and they're kind of mixed up. But to me, it was more on the weekly chart, and this is the daily. But you're kind of into support. That's often how it works. You squish into support. I don't think of support as like cement. I think of it like a trampoline, right? We kind of squished in, and then it's springing upward, and that weekly chart looks fantastic. It's up big, but I would continue to look to buy the dips in the short term. Play this thing up towards 100 overall. So we'll probably have a pullback, a consolidation, just continually looking at that one for further upside. Here's Unilever. This one is more about highlighting something of the type of stock I like. What do I like? It's international. Those stocks are outperforming. What do I like? Nice basing pattern after a big run higher. I wouldn't probably even wait until the breakout. I think you could buy here on another little push down, call it a little mini cup and handle type of idea. One more little pullback day or something along those lines, and I think I would be ready to buy. XBI, this is the biotech sector. Here, again, I think you can have a little bit of a pullback, but it's basically breaking out of a really, really tight range. And since the breakout went to the upside, this is a stage 2 breakout, we now turn into buy the dip mode. The biotech group looks like it should trend higher for the foreseeable future. So those are some things that I kind of looking at and potentially going to trade on the upside. Now on the downside, last week we highlighted at Archer Daniels Midland and said watch for a bounce back up, watch for these rallies, and you might get your spot. I think we're pretty darn close or even there in ADM for a bearish trade. You have a rally up after a breakdown. Notice the breakdown was on heavier volume. Notice the rally is on declining volume. It's kind of picture perfect bear rally pattern. The problem I have is the same problem I've been talking about for the past couple of weeks. I'm bullish. So do I want to have a lot of bearish trades? No. I've been very, very skimpy on my bearish trades. I've got a one or two type of bearish trades, and that's about it. I've been certainly loaded up on the bullish side, which has been helpful. But if you're considering bearish trades, well, that would be a consideration. Cigna, okay, rallying up. This is actually one that I have now entered into a position in today. So speaking of bearish trades, I probably almost doubled, the amount of bearish trades I had on by putting on this one. I can only think of one other bearish trade I have on besides Cigna, but maybe I have another one or two. I don't think so. I think I've got two bearish trades on. But Cigna just got into a bearish trade, kind of the same concept. It's rolling over, short term, sold off on increasing volume, rallying on lighter volume. These are the characteristics you look for, and it should put in a lower high and trade down. Now, I don't know if it'll just come back towards the lows or break those lows and so on, and I'm probably not trading it that aggressively. For me, I actually entered into a bearish trade, and I don't have a set reward to risk because it's infinite reward. The more it falls, I could make infinite amounts of profit all the way down to zero, but I'll probably adjust it or exit it following a decline down here towards 300 or so per share. If it's not acting right, I'll probably just bail out of it, to be honest. I don't think I'll be spread trading it or doing anything that way. And then last but not least is UPS, and this one I could kind of go either way. I'm not sure I'm bearish. It's just in a tight formation. And the more you kind of come to the apex of the triangle, the more explosive it gets. I don't know if you're going to break out to the upside or if you're going to break down to the downside. Either one would be viable as a potential strategy. It should be running about 1,000,000 miles per hour on the breakout, and I'm guessing, I guess, that it could be down just because we kind of came down and then consolidated, but anybody's guess really because it could go either way. So the markets are in a long-term bear market. I don't believe that has changed. However, I've been expecting the same thing for the past few weeks. A move up and through that downtrend line. So far, so good on that expectation. Core PPI comes out on Wednesday. Earnings not as impactful this week, I would say, as they were last week and as they will be next week. Last week was financials. Next week we get mega cap tech, Apples of the world. This week's a little bit quieter. You've got Netflix, you've got Schlumberger, you've got State Street, but nothing as big and as impactful. So it's kind of a quiet week this week. We've got options expiration Friday for the monthly time period. We've got some things that are catalysts, but on the earnings side, a little bit quieter, and then it gets noisy next week. Have a great rest of your day. Hope you enjoyed the market roundup. On behalf of Maverick Trading, I'm Corey Halliday, and we'll see you next time. Goodbye, everyone.